Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info at yourmoneyontap.com. My name's Seth Cressman, joined here again by Dan Mickelin and Tony Scola. It is good to see you, my friend. It's been a while since you've been on Money on Tap with us, and thank you for getting us caught up to date on your adventures over the past. It's just really good to see you, my friend. How are you?
I'm doing great, Seth. Thank you. It's great to see you guys. It's good to be back.
Dan, I didn't mean to leave you out of the mix, man.
No, that's all right. It's always good catching up with Tony. That's all right.
I see Dan more than you, Seth, so.
Yeah, star of the show for today. We have big expectations for Tony.
So. Oh, pressure.
Yeah, right. Yeah, a little bit of pressure here. As there is all around, our show today is on dividends and interest. Dividends and interest.
What's the difference?
And, well, that's exactly right. What is the difference? And that's going to be what we're talking about today. Besides Tony having a phenomenal trip over the summer. Well, it's been a minute. Gosh, it's been a while since I've seen you now that I'm thinking about it. It's been that long. And you've gone to Africa, and you've seen Def Leppard, and what else have you been doing?
Spent some time on the water, but also working. That's the great thing about technology, right? You can be anywhere from anywhere.
Yeah, it is. As a matter of fact, I mean, right now you guys are in Bedford, New Hampshire, and I'm just outside of Portland, Oregon, and we get a chance to put a show together today and have some fun talking about dividends and interest. And it is fun to talk about dividends and interest. As you'll learn today, there are differences. Both are, well, I'm not going to give away the show. We'll get there eventually. But before we do, let's just take a couple of minutes here because it's time for Money in the News.
And first up for Money in the News, we got this article coming to us from Fox. This is by Greg Norman. And the story I found kind of amusing and interesting, but a Chicago man secretly leaves behind life-changing $11 million estate for, believe it or not, 119 relatives, which is just astounding. But really what the detail is here, what the story is that this guy in Chicago was 87 years old. He died just before Christmas in 2016, and he had an $11 million estate without any designated beneficiaries or, at that point in time, any known relatives whatsoever.
Right, no direct heirs. That's what's fascinating. It was actually unclaimed property.
Right, yeah, a big windfall to the state there, but they have an obligation to pursue rightful distribution, and amazingly enough, they really dutifully took this upon and this challenge, and they really kind of dug through the weeds to find these folks. So that makes it kind of a doubly amazing story that there was this much hustle put into it by the by the state here to send money outward. But they were able to identify rightful heirs here. There's 119 of them in total, but just a handful of them were here in the U.S. They were primarily in Poland and Slovakia, which caught my attention. My wife's Slovakian or from Slovakia, and unfortunately, she's not on the list here, and we read the article after they'd already identified these folks and paid out the money, so with no chance.
The odds were pretty good, though, on that, weren't they?
It's not a big place, yeah. So, I mean, there's a measurable percentage opportunity there for us, but, the money had already been paid out, and the folks identified by the time the article got published here, obviously, but, there's a couple interesting things. The other part of it was this guy that had passed was one of seven. He was the longest living sibling. But between all seven of them, only two had ever married, and none of them had any children whatsoever, which is pretty amazing.
And they had all passed away before him as well,
all
which
passed
was
away.
Part of the issue. No wife, no children, no siblings.
Yeah, and they also, I mean, there's a few interesting things. But I mean, literally all they know about the guy is that he owned a boat named Easy, which is interesting, and they've got no idea how he amassed this kind of wealth. They have really no idea where the money came from. He's a very quiet guy in his community, and he just passed away. But I think the biggest thing to note here, as it relates to planning and what we do, is that number one, designate beneficiaries. If you have anything at all, figure out who you want to leave it to, and get that attached to the various accounts and holdings. And if you have a will or a trust or anything set up, which is always advisable, make sure you include everything in it. Not that this guy had anything at all, but do make sure that you designate, for each and every asset, who's going to receive it when you're gone.
And that brings up another point, Dan, is also regular reviews as well, because when things change, I mean, it's not very frequent, but more than you would think, that especially with marriages and unfortunately with divorces,
yep.
People forget to remove their spouse or prior spouse, and if that's who's listed as a beneficiary, that's who gets your money, regardless of what you might have intended.
And for those who aren't married, and we see that a lot, is obviously kind of. Divorces that have not been updated as far as beneficiary tracts go. We see that fairly often. Or not that we see it often, but if there's something that we run into, that's probably the most frequent. But the other thing to think of is that, if you're not married and don't have children and you're naming siblings, people don't update that as the siblings pass on and potentially predecease you. You want to make sure that you've adjusted percentages and make that part of the record as well.
You guys are being so appropriate in the planning world, which is where we live most of the time. We're, if you're not familiar with Money on Tap and who we are, we're all financial planners. We are partners at Brayshaw Financial Group. And so this is one of the fun ways that we get an opportunity to engage with your audience and, have some fun in the articles of what's going on in the news, and bring a topic that, is educational as well as hopefully experiential, as you are out there investing in your world and with your families and looking forward to retirement. This is a great way for us to start a conversation around your retirement, and what does that look like, and what does that mean, and how does three-dimensional investing look like for you? And that's what we do at Money on Tap. As you guys were really getting into the nitty-gritty there on the planning, I just was amazed. Just kept popping off the page at me that Joseph Stancic was alone in 2016 when he passed away. So this is recent news, folks. We're not bringing a 2016 article here to you. This is recent news that this all happened. This estate of $11 million passed to 119 heirs, and he was alone. But he just didn't even have this window into these 119 heirs of his. And I'm guessing that, this is probably a pretty good story for Netflix to pick up the rights to and maybe turn it into the secret life of. But also just some interesting life bit there for you, that you're not alone as much as you might feel like it. And if you are, if you've accumulated wealth and you think, hey, I have nobody to pass this to, you probably do. But it's the way they had to reverse this was up the family tree and then back down the family tree to locate these people. So it was really neat. I really appreciated you bringing this, Dan.
Yeah.
Thanks.
Well, also it's funny too. I mean, there's a bunch of things for such a light article, some kind of amusing facts in there and interesting things, but not a one of the 119 people had ever heard of the guy. No one had any idea who he was.
Wow.
So imagine getting that call, right? You're getting that call. Hey, long lost Uncle Joe from Chicago, just left you $150,000. I mean, that is a call I've yet to receive, but I'm looking forward to it. Sorry, Uncle Joe. I hope you lived a glorious life, but if you're out there, I got, arms are open.
Right. And the thing that jumped out to me, too, is like you mentioned earlier, Dan, is that, there's a kind of a statute of limitations in terms of family or heirs coming forward to take claim or ownership of this undeclared assets. And as you said, they went beyond that to track these people down. And, kudos to them to not just take the bird in hand.
Yeah. Yeah, a lot of good work there. So next up, we get an article from the New York Post. Kanye West no longer a billionaire after Adidas cuts ties. This one I thought was interesting because it's, it's front page news. I mean, it was all over the place when this was first happening. And, obviously what the kind of triggering event there was some unfortunate comments from Kanye, and that's not really the part of the article we're interested in. Certainly it's got no kind of investment worthiness in that end of things. But what is interesting, or what applies here, is that if you're looking to invest in a company that opts to co-brand with a celebrity or someone of note, a living person here, be mindful that some of your investment value is going to be tied to this person, and with the social media platforms like Twitter and all that out there that just allows for kind of instantaneous, widespread sharing of thoughts that may not be the best or the most appropriate, there is some significant exposure there. And Adidas certainly felt that, and Kanye himself really felt that, at least according to this article.
Well, and to your point about social media, I mean, it would probably be, I would assume, very appealing for younger people to try to latch onto investments that did co-brand with a celebrity or musician, an athlete that they looked up to or that they felt had some value, and say, hey, look at this. Adidas is with Kanye. It's going to take off. This is a great thing to invest in. And look, it actually is probably going to reverse all of that type of potential for the same reason they might have invested to begin with.
Yeah, I mean, Adidas acknowledged, obviously this was a hard move for them, I'm sure, because, their association was profitable. They expected that it was going to cost them $250 million between kind of the severance date and the end of the year, which this happened in October. So, it's a pretty substantial hit that they're willing to take just to part ways and separate company with this guy. Go ahead.
Yeah, a little bit of an insight here. Like just last night, I was in a meeting with another partner at Adidas, and it just happened that way. Not even planned, just happened that way. Just getting caught up. Like, hey, how are things? And her perspective on life was very, very different. It was just it was incredible to listen to her go through what the turmoil of that company has been like for the last 2 weeks from when they heard about this, and them making the decision. The dialogue back and forth between people that are Jewish in the company, and it also happens to coincide with Diversity Week at the company. And
it's holiday season as well, which is also, for this brand, a particular, time of larger profits. So, like you said, you're saying, Seth, it's just so many factors that are going into the timing on it.
Yeah. Hard to believe that article also called his now comparative paltry $400 million that he's worth to the $1.5 billion that was attributed to this relationship with Adidas. Just unbelievable, astronomical, those kind of numbers. And how did the evaluations work on that? And there was some discrepancy there within the article as well. I think some of them had them, and that was part of Kanye's or Yeezy's issue, is that people keep on discounting what his real value is and what he's done within his world and his industry and everything else. But anyways, the numbers are what they are. We don't know what that's going to mean as far as an outcome here for either Adidas or Kanye, but wow, what a story.
It's just, it's one of the risks you take on if you invest in a company that is, so closely aligned with, to your point, Tony, celebrities and athletes and people that are, hey, I mean, we're all people, we're all apt to say some misguided things from time to time, although this is certainly of a different level and he's got a wider audience than most. But, just be mindful of that. It's something to, certainly be aware of, because if something happens like that, it can definitely have an impact on portfolio values and the value of a company anyway. And next up, we got here, stocks are having a stellar October, why the bear market rally may have more room to run. And this is coming to us from Market Watch by Joseph Andolfi. And this, I think, was an interesting article because, just contrasted to the series of shows we've been putting out with concerns around recession and how bad is the dip going to be, and when will this market turn around, and lo and behold, we've had literally the best October in history. So it's a tremendous rally here that we've been experiencing. How long it's going to run for, and what's really behind it. There's some interesting things here in the article, so I thought it was worth kind of diving into. especially on the heels of, since this has been published, we've had the Fed declare another 75 basis point rate hike, and the market certainly felt that yesterday, and started off a little bit south today. So yeah, it's interesting times for sure, but this rally has been kind of breathing a little bit of life into the market. And in our prior show we were talking about, how big of a dip is it, and that 30% number was an important one, that if we kind of eked on past, there was potentially some further sliding to go. But with this rally we've had in October, it's kind of pulled those returns up up away from that 30% decline barrier.
Yeah, giving the market a little bit of a breather, not too uncommon within the bear market cycles that we've been in. There's the bear market rallies. There's all sorts of other terms in there. But yeah, that 30% threshold there, that if the market really were truly to break through, statistically could have another run down somewhere closer to, who knows, 45, 50, 55%, depending on what the outcomes or the news are. But the things that we have to look forward to are, certainly some more things within the Fed, the rate hikes, and, some of the earnings seasons that we've been going through as well. And what's the overall effect that we're going to start to see or feel throughout this economy are all factors within this market that we're in right now. One of the things that on the bright side, I always love the bright side, is how significant the October rally was. In terms of, the size of it. That's pretty amazing to see a market just take off like that. I mean, we have been, and frankly, the markets that we've been living through in the last, 15 years are nothing like the markets that people experienced previously. And we've had this conversation so many times before around just the volume and the amount of capital and how it's really pushing through the markets and what that looks like. It's intense. That's the only, no other way to describe it. It is intense to see a sell-off happen the way that we've seen it happen, or a buy-in happen, a buy-up happen the way that that's happened. And people feel that differently today than they used to when they were just pulling out the Wall Street Journal and seeing yesterday's news. It's all real time. It's the awe and the shock value kind of market that we television that we experience, if that's how you're getting your news, or you just pick up your phone and look. It's hard sometimes to just take a breath and just go, you know what, this is okay, and this is going to work out. That's my 2 cents on that.
Yeah, it kind of it's not in the article here, but Tony and I had a meeting this week that I thought was kind of interesting with a former manager. And what they shared with us, I think it leads into some of the volatility that we experience these days, is that, when they were managing portfolios directly back in the 90s, there was 7,000 investable tickers, right? That was the sphere of potential investment. Today, there's only 3,500 because of mergers and acquisitions and companies going under, and not as many, choosing to list. And there's more money in the market now than there was then, significantly more. So every time you see a move in a company, the volatility that creates and the effect it can have on the index, especially with how heavily weighted our indexes have gotten, extremely top heavy, with not a lot of options to invest in behind, at least comparative to history. It really does set the table for a lot of volatility going forward.
That's true. And I think that's what this article really points out, is because it does kind of bounce back and forth between the positive and negative potential outlooks. And I guess the consensus is that there's still some volatility on the horizon. But the thing that jumped out at me is kind of interesting, is I hadn't realized that, we had hit a lowest intraday level in more than 2 years just prior to the rally, which took less than 30 days to bring back above that level. So it just shows how drastic, to Dan's point, those swings can be and how quickly they can happen. And, to the point of the earlier conversation about Kanye and some of these companies and how they can affect things with, we just finished third quarters going into the holiday season. And, we're going to talk about, tax loss harvesting, things like that happen at the end of the year. There are a lot of things still going on, midterm elections next week, that are going to impact the market. But it's a good time to remind folks that that's why, a logical, planned out, investment strategy that is aligned with your risk profile and your goals and objectives and your time horizon are more important, so that you're not making emotional reactions to things that are going to impact market moves. But in the end, you can see how things typically, even after these events, tend to rebound and move forward.
Yep. That's going to do it for Money in the News. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about dividends and interest. What's the difference? Well, you'll find out when we come back.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement, is a successful experience? We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million, look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that that next step is right.
We appreciate you listening to Money on Tap. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You are listening to Money on Tap, your personal finance headquarters. And you can reach us at 855-226-8551 or info@yourmoneyontap.com. Today we're talking about dividends and interest and what is the difference. And you may not even know what dividends are, or when we say interest, most people understand that from one way or another, whether it's, you have a credit card and you use some money on your credit card and they start charging you interest. It's money that they've lent you, and now they're charging you for the use of that money. Well, if you're on the other side of that, you're an investor, and you can lend money, and you can now be the recipient of interest from lending the money. And some of those are classified in different ways on risk, and there's different interest levels based off of risk, and there's different forms of lending out there. Any way it comes down to it, interest is going to be coming from you borrowing or you lending. So that's one of the first places that we want to stop for a second and have a conversation.
Yeah, I mean, CDs is one of the things that people, quickly associate with interest, and it's because it's just such a commonly used instrument. And what you're doing there, I mean, people think of it in a lot of different ways, but the truth of it is you're lending your money to the bank, and they take that money in and they lend it out elsewhere. You're doing that in exchange for a rate. And as all things are tied to what the Fed does when you're operating in the interest rate world, rates are up. Things are improving there. As the Fed continues to move up, and they have recently made another hike. And what's important to note about that, because hopefully they're going to be slowing in the process that will have an effect on all these things, because they've been fairly dramatic with the pace of these rates. But right now we're up to 3.7 to 4% is the current Fed rate. It's actually not an exact number. It's in that range. But they've declared that they're targeting 5%, which is a little higher than initially was expected, as kind of a goal. But as a trade-off on that, they've also, they don't come on and declare these things, but they've hinted at the fact that they're going to kind of lessen the pace, so there won't be as dramatic as increases as have been going on here for the last 6 months or so. But clearly, there's still more upside to that Fed rate. But what that's translated to for people who have money at the bank, and this is important. It's obviously, it's a good place to get safe interest earned. But a 1-year CD right now is at about 4% on average, and the range is up to a 2-year. You can get 4.1%. So, it's been a dramatic move from. I mean, just a year ago, we would talk to people about earning virtually zero at the bank. So, although you're not going to be outpacing inflation at that rate, it's still something, and it's significantly better than what it was.
Exactly. I feel like that's a good point, is that some of these more secure interest-bearing accounts, these savings accounts, CDs, et cetera, tend to lag total return. But as you said, as a short-term place to park money, especially as we were speaking about earlier in a volatile market, at least it's good to see that there's some options that are producing some yield.
Yield. That's another term for interest. So some different places that you're familiar with or that you've just heard about is the CDs is one of the most common ways that people get first and foremost investor experience is going to the bank, putting money in the safe, or not the safe, but the I don't know, maybe you do, but you put it in your savings there. And what usually happens is you get to a certain dollar amount, and one of the tellers will say, "Hey, have you heard about our CDs?" And that's kind of their job there, is to start to, funnel money from savings and checking over into these other places. And what they'll have there is they will have CDs that Dan was talking about, which are certificates of deposit. And these are guarantees to pay you if you lock in a CD or invest in a CD. They'll pay you an interest rate, a guaranteed interest rate, for a certain period of time, whether that's 6 months, 1 year, or you can take those out, up to 5 years or somewhere in that range. And if you understood what Dan was saying there about the 4% being paid on a 1-year CD right now, and then we also have the Fed that's recently just raised rates again, we might see that 4% now go up. Now, probably not a direct correlation to, the 75 basis points or 0.75 that they just raised interest. Now, it's not likely to happen because that's just not the way money works on the backside. But there will be some banks out there increasing their CD rates. And one of the other things that's interesting to note there is maybe you're a new investor or just a safe money investor with these CDs is that 4% that you were able to get for the year. If you looked at the 2-year, you might think the 2-year CD, you might think, oh, well, if I'm getting 4% for a year, then they'll probably give me a lot more for, 2 years. Well, it hardly moved. There was hardly any difference between that 1 year and the 2 year. So what would your mindset be there? Either one of, well, maybe the rates go back down in a year, and I want to make sure I get that 4% if they bring that rate back down. So you might want that 2 year or 3 year, so on and so forth. But if they're in a rising rate environment, probably the shorter term of the CD would be what you want to take a look at in that circumstance, because you might be able to swap it out, pay a little bit of interest on your way out, but get a better rate and lock in a better term down the road.
And there's another thing to consider here, too, is that, a lot of what the analysts are forecasting, and who knows if any of this will prove to be true, but, what we have heard is that, that the interest rate is likely to recede as quickly as it's gone up, right? So there's a notion out there that, once we get to that right level of Fed rate, that inflation will really begin to tail off and that the rates will come down. So if you want to view this as an opportunity to try and lock in what's been, at least in our recent history, a very attractive offering in the fixed rate world and earn some interest, there are opportunities in the annuity world that would allow you to lock in kind of the present state of affairs on a rate for a longer period of time. For instance, we can get you a 5-year guaranteed annuity. So it's going to pay that same rate over each year for the next 5 at over 5.3%. So if you think in annuity rates and CD rates 2-3 years from now are going to come back down to where they've been in that 1% range, we do have an opportunity that can lock in a guaranteed interest-paying 5% plus contract for the next 5 years.
All right, hold on there, Dan, because right now I'm really feeling like I should probably get our phone number out there. People are like, wait, what did he just say? But wait, there's more.
Get a wild time.
This is not a fixed rate vehicle infomercial for you folks. However, You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about dividends and interest, and what Dan was just talking about there is an annuity that's a fixed rate annuity that is paying over 5%, has a term that can get locked in for a duration of 5 years. And that's one of those other like guarantees of principal that we talk about. How do we guarantee getting receiving an interest income off of you lending money to somebody else?
And that's exactly what it is. When you buy an annuity, you're lending the money to an insurance company for a guaranteed return of your principal plus some interest over all kinds of varying terms. But those are two of the main options that we want to talk about that bear interest in this conversation of interest versus dividends. But we're going to dive into a few more here coming right up.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about dividends and interest. What's the difference? We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about dividends and interest. What's the difference? Well, folks, there is a difference, and we're and I'm double speaking as I come back to that. I realize, one of the things I wanted to just talk about for a second was, what are we doing here on Money on Tap? Talking about three-dimensional investing. All three of us are financial planners with Brayshaw Financial Group, and that's one of the things as independent financial planners that we really truly focus on is our clients and making sure that, as we're talking about things that are, kind of product specific, like a CD or an annuity, the point is not the product, folks. The point is you and your retirement. And how do you do that successfully? All of these things, all of these instruments in the market, whether it's a stock, a bond, an annuity, or whatever it is, they all have their place and time to service and accomplish a goal. Now, how do we get to this point of being able to make sure that you guarantee that you retire successfully, and that you don't outlive your income, and that no matter what the market's doing, up or down, you have the tools in place to be able to have the freedom and the peace of mind to retire the way that you want to, not worrying about it, right? That's what I assume all of us want, is we don't want to have to worry about what this retirement is going to look like. And that's what we're talking about here. This is some of the greatest stuff that we've had an opportunity to talk about in a while in terms of fixed income instruments because of this raising rate environment that we've been in. So here it is, folks. We've got some more for you. Go for it.
And that's really an excellent point, Seth, because I was thinking about that just before our last break, is that, as planners and as people who are looking out for the best interest of the people we work with and helping them reach those goals, you're right. There's a lot of products and solutions available, and some are more exciting and appealing to some people than others. Some people love the idea of and excitement of stock investing, and others like the security and safety of the fixed income or the CD. But in reality, what I tell folks is, there's one of the three-legged stools in planning is, that you only get really three things for your money. You get safety, liquidity, and return, and you're not going to get all three with one particular investment. So that's why it's important to kind of be able to determine how much of your overall pie gets broken down into these buckets that create your security, your liquidity, and your return. And having a higher rate of return, a higher yield on fixed income products is a great opportunity for folks, but how much of it goes into that type of investment is really the question. And that's the thing that I think a lot of people struggle with and why they, come to us for some guidance.
One of the hottest things that's kind of been in the news lately has been this I-bond, right? It's an inflation-linked bond issued by the U.S. government, which makes it AAA rated and considered to be as safe as you can get as far as an investment goes. And they've been in the recent past paying up over 9% because of that link to the inflation index, which is obviously a phenomenal return. The issue is that it's a 30-year bond and it doesn't pay that rate over that entire period of time, not even close. In fact, the rate on those has dropped down to 6.89, which is still attractive. But one of the things that they've added as a feature to the I-bond very recently that I think is going to make it probably more of a viable consideration, considering the duration of the investment you need to kind of make there, is that they're now offering a 40 basis point, a 0.4% increase over the inflation index rate for the life of the bond, which is a new add-on. Previously, that was just 0%. So they're giving you a little bit of a kind of a kicker rate to stay in there and allow the government to continue to work with those dollars, which is obviously an issue right now with our spending track. So there are some kind of unique new opportunities, or I shouldn't say it's a new opportunity, but it's new that it's interesting again, and that's out there right now. So for people who are looking for a safe haven, it's something to consider. Issue with it being is that you can only put $10,000 in there per individual or per registration. So it's not going to be a safe haven for all of your money, but if you've got some assets that you just want to set aside and that looks like an attractive number, an attractive rate for you, there's certainly that consideration. And when treasuries are hovering around the 4% marker right now, you can see that there's a little bit extra incentive to consider the I-bond there.
All right, what's a treasury, Dan?
Treasury bond. That's a U.S. government-issued bond. Probably should explain that a little further. So the U.S. government's willing to pay you 4% on your money or thereabouts. It fluctuates daily. But it's going to be a relatively long-term hold. If you're going to hold the bond through maturity, collect your interest coupons for now, and then get your principal back at the end, that's one thing to consider. However, if the Fed does continue to raise rates, the concern being that if you're going to potentially get out of that bond at some point before maturity, you're likely to see the value of the bond decrease.
And go ahead, Seth.
Yeah, no, I was just going to jump in on the some of the difference. We're transitioning here from some fairly common fixed rate vehicles, the CD and then the annuity world, which are those guarantees to pay. Still an activity of interest. You're getting interest, so you are lending money to those organizations. And one of the largest lending organizations out there in the world is the U.S. government. The way that they do it is under the bond. And bonds are publicly traded. You don't have to go to the bank to buy the bond. You go actually to the market, you buy the bond, and depending on what's going on in that bond world today, that's going to make a difference on what ultimately your yield is, or that interest that you're getting from lending the money to the government's going to come back at you with. So that's one of those things that people just may not, quite understand getting involved in bonds. Yes, there's probably going to be less volatility, right? Less up and down in those instruments. They are historically what we've used in our portfolios as we build portfolios for our clients to provide income, or that interest income coming from them, but also to try to stabilize a portfolio so that when the market's going up and down, the portfolio doesn't react the same way as the market. However, bonds are liquid. You can trade them. Just like you can go to the market and trade a stock, you can trade a bond. And if you were trading a bond in June, and right alongside with the market falling out, I mean, it was coming down, so did the bonds, almost by 20%. And that's historically something that we don't typically experience in this market, but it is something to be very aware of as you're trying to build these income streams and understand there's just a difference here. And bonds do have ratings too. How do we understand which bonds are going to give us a greater, like you said, there's the liquidity, right? Go ahead. I want to hand that back to you. I'm going to go ahead and put a pin. I didn't realize I've been talking for 5 minutes, so go ahead.
Oh, no worries at all.
I'm putting Tony to sleep. Let's go, Tony.
No, not at all. I'm riveted. Because actually that was exactly where I was going to go with that anyway, Seth, was just to kind of give a little bit of education on what bonds are and how they work. And did you need the rest of that, the liquidity safety return piece?
Yeah, no, I don't want to steal your thunder with that.
Oh, no. It's just a way for folks to visualize, what their monies should be doing or what their investment should be doing for them. And, to kind of continue on with what you were saying is, I do find that some people get confused with why bonds being considered safe can lose value. And Dan mentioned it earlier with the I bonds being a 30-year hold. You'll get all of your money back if you hold to maturity. But as Seth was just talking about, bonds do trade. So if interest rates go up like they just did, somebody wanting to purchase that bond in the market is going to pay less because it's yielding or it's paying out a smaller amount of interest than the new issued bonds. If you held to maturity, you would get all your interest and your principal back. But if you want to sell a bond you already held to buy a new bond that has a higher return, you're probably going to realize a loss on that bond because not nobody, but people aren't going to be willing to pay as much for it as you did when that rate was appealing 2 or 3 years ago. Another piece to understand about how these investments, when you understand them a little more, can be a little bit less scary, but why it's important to really know what the purpose of that is in your overall portfolio.
Yeah, and I think this would be a good time. I think we've kind of covered the gamut of interest-producing instruments, right? So we covered CDs, annuities. We just delved into bonds and government bonds and how they all work, but continue to be rate sensitive. Basically,
well, we didn't cover one, Dan.
What
we
was
didn't
that?
cover one. That $100 I gave you, you owe me.
Is that the 10% per week loan? Is that one?
That's the one I'm talking about.
The one where you send Tony over to collect if he doesn't pay?
That's right.
This Tony? The other, moving on to the legal investment world and lending world, is dividend stocks, right? That's something that you've heard us talk about very frequently on the show. We all believe here that in times of inflation and uncertain, stock values and portfolio values, that dividend-paying stocks present an opportunity to, at least get paid on your investments, while the price is fluctuating. We advocate for that as a great way to produce income in retirement and as a way to kind of buoy your portfolio as if you're making systematic investments, as an example, that pay a dividend so you can, continue to buy and reinvest those same stocks. As the price declines, you're buying them cheaper, creating the income, putting that back into the portfolio, and then when the stocks finally do turn around and begin to appreciate, you'll own more shares. So you have an opportunity to really benefit from that experience. But there's a number of dividend-paying stocks that have actually, and these are S&P stocks, by the way, so not small companies, that have been outpacing even the I bond rate, which is really amazing, and there's potentially a good opportunity. And then we're also going to get into a strategy here following the break that people utilize around year-end. Both individual investors and institutions, take advantage of this time of year, especially following a market like we've experienced, to create some tax benefits for themselves, but also potentially catch a ride up when the market does get back into better footing.
Gosh, Dan, when you were talking about the stocks there in the S&P 500 that are paying a dividend higher than that I bond, I just had two words almost pop out of my mouth: hot diggity. So that's probably what we should have titled the show. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about dividends and interest. What's the difference? And landing the plane here with us today, it is all about dividends. And this is a great place for us to just, wrap up this show early and spend some of our final minutes. The dividends, right? What is the difference? Where do these come from? We've talked about lending money and lending equaling interest, and different places you can do that. There's the CD, there's the annuity, there's the bond. The other side of this is the dividend. Dividend has to do with buying or owning a company that, when they're profitable, part of the profits that they spin off, they do it in a dividend. and that's how they're paying you out. If you take a look at many stocks on the market, you can buy, sell, and trade them at certain points throughout the year. They may or may not be paying a dividend. And that's one of the first things to understand. This is, it's not guaranteed, right? That's one of the first things that you got to understand with a dividend. It's based off of what the capacity of that company has and the decision that they've made to share with their shareholders in that income. If they have it, then they'll usually pay it. But then sometimes they make decisions to do different things with the income inside of that company. It's their prerogative. What you can take a look at there, though, is A, do they have a dividend? And what's their history with it? And what's currently happening inside of that company, as much as you might be able to take a look and understand. Most of the companies that have historically been paying dividends over time, those are places where people would probably say they've got a safer dividend, or they've increased their dividend every year for the last 10 years. So those are stories that people like to try to understand and buy into, or before they decide to invest inside the dividend story.
Yeah, I mean, there's good companies that pay dividends, and then there's places where there's some risk. And just understanding, why a company would choose to pay a dividend. If they have, first of all, companies are supposed to operate on behalf of their shareholders, contrary to what, Elon Musk might say, but, it is the truth. So if they have that free cash flow and they don't have a ton of debt to manage, and they're being, they've had a profitable experience in a given year or time frame, they're likely to pass that on as a dividend, right? Is they're, again, performing on behalf of their shareholders. But companies that aren't faring so well know that, portfolio managers and investors look for these dividend yield numbers, and they may be borrowing money to pay a dividend to basically manipulate their stock price to drive investors in. So, to Seth's point, before you just go ahead and jump in on a company based upon the yield rate you see, check that track record of paying and make sure that they have some history to doing this, and they pay a dividend because it's something that's core to the company's principles, as opposed to trying to create a short-term splash for themselves.
Oh, yeah. And just to add on to that is, I think the question that comes up often is why, other than the fact that, there might be fluctuations in the company's earnings, why they might not pay a dividend. And I think that's when a lot of people have heard of what's referred to as like a growth stock, whereas the company's reinvesting those earnings in the company to grow it. And we saw that with there's a lot of tech companies, I think, that were very large and successful growth stocks for people that didn't pay a dividend initially. But now you're seeing that they do, because as Dan was mentioning, not to say that they run out of things to spend those profits on, but they've determined that they're cash flush enough that it makes sense to return those earnings. As a shareholder, as a part owner of that company, you're entitled to benefit from what the purpose of the company is, which is to make money, and you should share in those profits.
And that's why we thought, some of these kind of high dividend paying companies that are part of the S&P 500, might be an interesting look. And this certainly isn't advice for anybody to jump into any of these particular companies. But, I mean, the line of rationale here is that, well, if you're in the S&P 500, you're a company that's obviously very large, you've been around, you've got a track record. And if you're in a position to pay a dividend that's outpacing this I bond, well, that's got to be attractive for people who are looking to create income off of their stock holdings. And just to give a couple here that fall into that category, Lumen Technologies has had a tremendous year, 13.59% dividend yield, which is really tremendous. Pioneer Natural Resources is a company paying a 9.9% dividend, and it's up over 120% from the prior year. So not only getting performance in the stock price, but you're getting a great payout there as well.
Yeah, one of the things that can be really challenging inside of this world is the evaluation of that. Just for instance, the energy world. I mean, it wasn't that long ago that we went through oil was trading at zero?
Right.
Yeah. And there was all sorts of upheaval in this industry. And here we are, a couple of years down the road, and these companies are, some of the hottest tickets out there. So, those are tremendous returns inside of the world. I mean, those are just, frankly, those are interest rates that you don't hear of very often. Most of the time when you're taking a look at the dividend investment story, you're talking about, companies like Microsoft, right? Are they 2%? That's kind of what they're historically kind of giving you, or Apple at 1.5% or something along those lines. And then to see, some of the other companies like Verizon paying, almost a 7% dividend. Well, guess what had to happen inside of that Verizon stock in order to, make that level of dividend available? It had to come down, because it wasn't always just like buy Verizon, get 7%. It was, it's been buy Verizon, get, I don't know, maybe 5.
And that's a good point to make too, Seth, is that the dividend percentage, the earnings distribution is declared and is static during the period where it's declared. The yield percentage is based on its relationship to the stock price. So you might receive the same dividend quarter over quarter, but your yield could be higher based on what the stock is trading at. If your yield goes up, that means the stock price has gone down. But as Dan mentioned earlier, if you use dividend reinvestment, that could also work to your benefit, because you're using those dividends to buy additional shares at a lower price, which are going to produce more dividends, and it can be a bit of a little earnings machine there, so to speak.
Which kind of plays into the strategy we wanted to leave you with here as we kind of wrap up the show. And this is time tested, and it's proven to be a winner for people and institutions kind of over the long haul. And some of the stats that we put together on the show track this back into the 80s, I think 1986. But around year end, institutions, mutual funds, especially in a year like we've had where there's been a lot of losses, a lot of blood in this market here, they will begin to sell off some of their steepest losses in order to offset whatever gains may have happened over the course of a year. So it's a tax strategy, right? So you're selling losses to offset your gains. And what happens here from the institutional perspective, when you have these mutual fund companies looking for opportunities to sell, okay, and lessen the tax burden to their individual investors, that's going to drive the price down on those companies. But that driving down effect of the price is driven simply by the tax strategy. It isn't necessarily a statement on the worth of the company underneath. So you can find opportunities where there are companies that have been down tremendously for the year but are still paying a dividend that are about to get discounted when these institutions start kind of letting them all go.
And that's kind of a temporary dip then.
Yeah. Usually these companies by January, February, or have started to recover and are back up on the rise. Certainly you don't want to do this. You don't want to sell it and then buy it back within 30 days because then you lose your tax benefit. So that's what these institutions are looking at too. So they're going to sell it now. If it's a company they believe in, they're going to realize that loss so they can offset their gains. It's a tax play entirely. And then they're likely, or they have the opportunity to get back into those companies in the first quarter next year, and you'll see that kind of up effect on the price happen because there's more buying pressure. So if you're looking at your portfolio and if you've taken some losses this year, which we all have, you can look for opportunities to sell out of a company now, realize that tax loss, offset your taxes, but then look for opportunities to buy other companies that don't buy the same one, but buy other companies that have experienced something similar that you believe in, that are probably about to get an even steeper discount when these mutual funds start letting go.
It's a great idea.
Great stuff. Go ahead, Tony. We got to wrap it up, but you got 1 minute.
Oh, I had nothing to add, but that's a great idea. But just to remember that there is a window for that, and also to remember that the institutions are doing it during a particular window, but the individuals, as Seth just mentioned, or Dan, to be able to harvest your own tax loss and look for something new. You're selling your loss, looking for a sale from an institution. The individual window is even smaller. So also remember that's during the same period, but actually a different timeline than when the institutions
tend to let go about now. Kind of going into November because they have a forward-looking viewpoint on this, and the individual investors usually sell right up against the very end of the year because they realize all of a sudden, I better dump this. I don't want to pay taxes on this gain I took. So, usually institutions go first. You might see a little double dip, kind of overlap of holding. But, for the strong companies, particularly the ones paying a dividend, you look to see that rise in the first quarter.
Folks, that's going to do it for us at Money on Tap. We've been talking about dividends and interest and what's the difference. Tony, it's been so good to have you aboard with us today. I still have not received my souvenir from Africa. I will let you know as soon as that arrives. And for the rest of you folks, I hope you make it a great week. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We'll see you soon.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.